We are looking at the subject. We are looking at basic accounting principles. Basic accounting principles. And we want to do some little definition. Or looking at introduction to the basic accounting principles. We are going to look at the nature and general framework of accounting. So, what we are going to look at is the significance of accounting. That's the importance of accounting. We are going to look at the historical background of accounting. We will look at the definition, purpose, and quality of accounting. We'll look at the principles and types of accounting. We'll look at the role of economy, and we look at roles of accounting standard. That is the law that guides accounting, or that guides the preparation and presentation of accounting. Then we look at the form of financial reporting. So, what is accounting or financial accounting? Immediately you hear financial, your mind goes to money. Immediately you hear accounting or financial, your mind goes to money, or it goes straight to finance. So financial accounting is mainly concerned with method or process. It is also said to be a
analyzing, process of analyzing, summarizing the financial statement given to
when we talk about stewardship, the management that carries out the activity of an organization is expected to give account of their service to the public or to those that are interested in the financial situation of an organization. Because there are people that carries out these activities. There are people that make sure that they do the necessary things and earn income. They need to give account. They need to give account. Whether it's government, it's organization, or sole proprietorship, whatever kind of business you have, most especially I told you last owner, that is why you register it with CAC, that is Corporate Affairs Commission, an agent of the government that registered companies. So company is a legal entity. The company is also a legal entity where you do things that you do under the law. The same way companies come into being by law. So you register a company by a comma, that is CAMA 2020. CAMA is Companies and Allied Matters Act of 1900. So you see that company, they have rules and guidelines that protect them. So the owner is not the company. That is, the company can be sued. And it can AZ and Co Limited. You have registered it. Someone can sue AZ and Co Limited, not a company. And your company can sue somebody because it's a legal entity. It's a legal citizen. So it operates under the law, just like it's under the laws of this nation. So those people that manage the company, we have to relate the way we performed. This is how we have performed so far this year, because it's always in 1 year. So they will look at the assets, the rest, and put all those things together. Are you following me?
Yes, sir.
Even the payment vouchers, the subsidiary books, original entry, the sales day book, the purchase day book, all these things are, to enable management to be able to give stewardship of what they have performed. And most times, the things they record or they put in place, they are, the best part of management stewardship, which is called bookkeeping. To keep records.
Okay, sir.
So what is the purpose of accounting? What is the purpose of accounting? It is to provide about the economic of an entity. To assist the direct users. And who are the users? The shareholder, the owners of the business, management, employee, short-term and long-term lenders, that is banks and you name it, direct users. So it means that the ones I have named so far are the direct users. We have the indirect users, financial analysts like you and I, investors like you and I that want to invest in the company, government and tax agencies, because the government tax agencies, you want to tax either using company income tax or personal income tax as individuals. In the information that the management of the company generates. So the purpose of all this accounting is to be able to do what? To make decisions and say, I want to invest in me invest. Are we there?
Yes, sir.
It helps us to plan. You and I, if you know that this and guarantee efficiency in all that you do, and enhance your productivity. Now, we want to actually look at the historical background of accounting, how accounting developed. It is said in Italy, in the 14th century, when Italian merchants started using double entry in terms of plus and minus. That is the first theory of double entry, which is what we call accounting. When it is not double entry, we call it bookkeeping. I want you to write that one down. Very, very easy. You are doing plus or minus. You are doing what? Accounting. You are doing what? Accounting. So, and this merchant, the level of bookkeeping, Pacchioli, one Father Lucia Pacchioli. I will write it on the board. I put my video on for you to see the spelling. He is an Italian merchant. Or he was an Italian merchant. And also an Italian monk. M-O-N-K, an Italian monk in 1494. He wrote a book that is titled Some Made. Some as in S-U-M, made, M-A-D-E. Some made arithmetical, geometrical, arithmetical, geometrical, proportionist, proportionality. I will write those on the board, which he published in 1494. Is very long. It's tongue twisting. However, no matter what, you can try and know it. Is it that you must write it? Of course, you can. But I would advise you do. If you find anything that leads you to talk about it that way. So, he is the one that put the principle of double entry system in place. Principle of double entry system in place. So, what it means is that it became very, very expedient for managers to report to the owners on the performance, the position, that is the net worth, and liquidity of businesses during the period under their review. And such report would include the following: the profit and or loss incurred during the period, how the financial resources of the business have been obtained, and how they have been put into use during that period. They report on the assets, liabilities, and the owner's equity, that's owner's capital, at the end of the period under review. And this period is always 1 year. Now, accounting continues to develop when we come into contact with local generally accepted accounting principle. We call it gaps. Different local, we just adopt some accounting principles that, are relevant to our situation in every country. And some of these accounting principles are even local accounting that's these account gaps, that is local generally accepted accounting principles, has gone international. And in 2010, some people put it under International Financial Reporting Standard, IFRS, particularly those gaps that belongs to UK and US of A, United States of America, and the United Kingdom. Those generally accepted, local generally accepted, gap, kind of, accepted internationally and turned to now. IFRS by the former, because of this acceptance by the president, by the government of then Goodluck Jonathan, Nigeria started following and deploying IFRS. I'm telling you how accounting principles developed in Nigeria, particularly in Nigeria. And we now deploy this IFRS at least to the minimum preparation of what? Of our financial statements. Of our financial statements. What is our financial statement? Profit and loss and other comprehensive income is inclusive. Statement of financial position is inclusive. Then we also have statement of cash flow. Then we have statement of change in equity. All these things are inclusive, and notes to the financial statement. All these things makes up even the organization policies on how they treat inventories, opening and closing, how they treat income they receive, how it is treated, either using the IAS that relates to income generation and income treatment. All these things were as a result of accepting IFRS. Now, limited liability companies also uses CAMA, Companies and Allied Matters Act of 2020, to prepare their accounts, and also uses it by auditors to audit and report on the true and fair view of the audited account, or the accounts or the financial statements prepared by the directors or management of an organization. And these are what they eventually, the annual general look at, the management or the shareholders look at the AGM. That is the annual general meeting. Accounting has gone beyond reporting. It has gone beyond reporting. Beyond reporting for decision making. Yes, it has gone beyond that. It has come to the level of tax management. government accounting, sustainability, environmental and social responsibility accounting. Now, the minimum standard, like I told you, is IFRS, that your financial statement must meet. So what is accounting trying to do? What is the process? The process of accounting is recording. But many times, let me start with not just recording. What do you record? You collect data, raw data, information. That is your source document. You collect those data, that financial data that relates to finance of an organization. You collect those data. When you collect them from where? From documents, receipts, debit notes, credit notes, all those documents that you use in transactions, even letters of credit, even letters to your bank to pay your premium, insurance premium, even policies, organization policies, stating how much you depreciate your assets, you amortize your intangible assets. All these things, you write them in papers, you type them in papers. Government management put the paper of what you need to do at the end of the period or within the period. It's not only buying and selling, no, or producing and selling, no. There are other things. All those things you need to do what? To get those information first, collect those data. Then when you have collected those data, you now record them. You record them into your source, your subsidiary books. Your subsidiary books, there are 6 of them. The cash book, the sales day book, the what's it called? The purchase day book, the return inwards and return outward day books. Then you have the journal vouchers or journal proper, as the case may be, depending on the nomenclature you want to use. All these things are your source subsidiary books. So when you put them down, you record them in your subsidiary books before you now use your double entry principle to post them to their account, to their ledger account, as the case may be. We've discussed this, but I need to talk about it again so that you'll be reminded. You'll be reminded. So like I said previously, when you do all this recording, you are actually doing bookkeeping. That is in your subsidiary book. If you keep subsidiary book alone, you don't move to the ledger account. You are doing bookkeeping. It is when you start doing double entry, like Father Lucia said, that you are now doing accounting proper. That is when you are called an accountant. But when you are doing bookkeeping, you are still a bookkeeper. You are just a bookkeeper. Now, all these subsidiary books that I've spoken about, we will expatiate on it subsequently in other classes. We will expatiate on it, even the accounting principles of double entry, we will look at them. So what are the purposes of accounting? I can enumerate it by number 1. It measures performance of an organization. mostly at the end of the year. Number 2, it gives information on revenue and items of expenses for the year. It provides information on the net worth, N-E-T, worth, W-O-R-T-H, on the net worth of an organization or position of an organization. That's statement of financial position, which is also known as balance sheet before. Of an organization, it shows the net worth, the balance sheet information. It shows the liquidity, that is how much cash and cash equivalent an organization has at the end of the year. The net worth is also the wealth of an organization. So what it does is that it shows the wealth of an organization. It reveals the asset, that is the non-current and the current assets of an organization at the end of the year. It reports the capital, if it is a one-man business or sole proprietorship or partnership. It reports the capital. For limited liability companies, whether private or public, it reports the equity, the non-current and current liabilities as at the end of the financial year. It also provides information or notes, figures in income. Now, when we talk about scope, we are looking at the purpose, what it covers. We are looking at what it covers. What does the account covers? What does account covers? Generally, financial accounting is covered in accounting. Cost accounting, performance management, auditing, government accounting, taxation, financial management, forensic accounting, social and environmental accounting, etc., and etc., and so on. And so on. We will look at cost accounting later in your next level. It's also covered in management accounting. So we will also look at management accounting, performance management, subsequent stage. But financial accounting is what we are actually, concentrating on so far. Even taxation, financial management, forensic accounting, social and environmental accounting. These are in other stages of our study to become a chartered accountant. To becoming a chartered accountant. It's a matter of semantics. Are we there?
Yes, sir.
There are other accounting like that accounting covered. There are other like account. Now, these four are kind of new branches of accounting, particularly the sustainability accounting. This focuses on the disclosure of non-financial or qualitative information. When we say qualitative, we don't use shareholders or the public as it may be, as the case may be. What we look at is the non-financial or qualitative information about an organization's performance to the external users or stakeholders. This information guides us. It guides particularly the supplier of funds. That is short-term and long-term funds. What is a short-term fund? Like OD, overdraft. A long-term fund is loans. The owners of the business and the equity holders are also suppliers of funds. Creditors are short-term funds. They are also part of those that give us short-term funds. So such information helps them to continue to make decisions, qualitative information, that is, information that are non-financial. Then we have project accounting. That's part of the four that I've mentioned, project accounting. There are some projects that involve huge amount of money. So we do the accounting separately. We do the accounting separately. For each project, you see us doing the accounting separately. And probably later consolidate it into one, into an organization's P&L. Because we have to do estimate how we actually spend the money. Then we have fiduciary accounting. The multiple questions.
Sorry, can I speak?